welcome everybody. Welcome on behalf of Sasfin Wealth. My name is Flynn Robson and I look after private clients. Glad you could join us today for what I'm sure will be a very, very informative discussion with David. For those very few of you who don't know David is our Chief Global Equity Strategist at Sasfin Wealth. And today he's going to be unpacking, I guess, a question that's on a lot of people's minds. Is Buffett still relevant today? Buffett has played a pivotal role in many wealth managers, money managers, investors alike with regards to their strategies and how they've made money over the last couple of years and decades. He's been the cornerstone of many people's investment theses and played a massive role in the investment industry. But is he still relevant? And I guess that's the question. And that's what Dave is going to unpack today. So looking forward to it. And once again, thank you very much for joining us. We will have questions and answers. David's very happy to take questions on this topic and any other topic with regards to investments afterwards. Just pop your questions in the Q&A or in the chat, and I will read them out at the end. I look forward to the chat. And over to you, David. Thanks a lot.
Yesterday, I never had internet. Today, I haven't got electricity, but you always have to have plan B in South Africa. But thanks, everybody. I hope I'm not too long. I really want to make this short and to the point and leave some time for discussions. So, but it's something that tackled me. And the reason that I tackled it, I was looking for a quote from Howard Marks, and I went through all my old notes from attending Buffett meetings and just saw the wisdom that he had left and all that I had learned. So I think that's the backdrop to what I want to say. And I think, the conclusion is that you can still learn enormous amounts from the man. I was indirectly introduced to Buffett in the mid-70s. I was doing a course in investment analysis through the New York Institute of Finance, and my textbook was called Security Analysis, Principles and Techniques. And it was authored by Benjamin Graham and David Dodd. And at that time, there was no CFA or investment management courses, but anybody who knew or who knows Warren Buffett, certainly knows of Benjamin Graham. And in those 70s, the equity culture as we know it today was actually in its infancy. The emergence of this culture, the emergence of equity involvement was only brought about by a surge in inflation that was triggered by several issues in the 1970s in a post-Vietnam US, and also including the dramatic rise in the price of oil that was inflicted by the large oil producing nations after the 1973 Yom Kippur War. So interest rates rocketed with inflation, and all of a sudden, interest rate risk took on a whole new meaning. Before that, the administrators of pension funds and of other saving vehicles invested their money primarily in the bond market, which provided decent real returns. But in 1979, inflation averaged 11.2%. This is the US. I'm not talking about South Africa because we went through a dreadful period of inflation as well. But in the US in 1979, 11.2%. And in March 1980, it reached a high of about 14.8%. It actually might have gone higher. That's a number I found. But the prime rate in the US in 1981 reached 21.5%. I know New York was bankrupt because of the effects it had on its bond holdings. So Paul Volcker was appointed head of the Federal Reserve, and his very strict policies that he introduced brought about a recession in the United States in 1980 to 1982. And he finally brought down inflation. It dipped below 3% in 1983. But before this episode, before all of this happened, the equity markets were trading markets. They were largely made up of private players who took bets on individual shares. No one had a long-term vision, or long-term strategy. You'd phone your broker and you'd ask for a tip. Even today, people say, give me a tip, which is a reflection of how we used to operate in those days. And the advertisements in those days, back in the days, there were always advertisements which would highlight the whisper, the whisper of a certain Wall Street firm, all designed to make quick profits. In other words, what were the tips around? And, when I joined in February 1972, my job, even though I was a chartered accountant, my job on the floor was to give prices to clients. They would phone up to find out what the prices were. And also I would just run orders back and forth to dealers. And there were no managed or discretionary accounts. And the only institutional accounts we had in those early 70s were mining houses. And they punted heavily in their own or rival mining shares. So at that time, my early education in the stock market came from the James Dine book. James Dine used to issue a weekly letter, and it was called How the Average Investor Can Use Technical Analysis for Stock Profits. It's still, today, it's a masterpiece. It's a wonderfully informative book, and I used to devour the chapters on the psychology of the market. I loved James Dine. I loved his advice, and I still use many of his axioms and teachings today, like, if your destination, and I'm paraphrasing, I'm using it for South Africa, if your destination is Durban and you catch a train to Cape Town, no matter how long you stay on the train to Cape Town, you'll never reach Durban. So get off the wrong train, get on the right train. And, it was that kind of advice. He who looks back with regret dies of remorse, or put the past behind, the future ahead, and take your profits quickly. Take your losses quickly and your profits slowly. So it was that kind of advice. And then I started to read, Graham, and I was introduced to Buffett's annual letters to shareholders. They were telling you that the best time to sell a stock was never. And they taught you not to get rich fast, but how to get rich slowly. And that you should only buy a stock if you understand what the company does, and then only to buy the share for less than it's worth. In other words, less than its trading price. Never do anything else. But that was all very well in those days where it was very difficult to obtain information on businesses. There was no internet. There were no business channels on radio or TV. Information did not flow as easily as it did today. You had to write to a company for its balance sheet, or you had to search old newspapers or magazines for appropriate articles. So, of course, if you dug deep and searched, you could find those bargains, value stocks, companies that were trading below their net asset value or below their intrinsic value. And that situation persisted for many, many years. And it was only with the introduction of the internet in the mid to late 90s that information began to circulate easily. And that had brought about immense change to financial markets, not only to the flow of information, the flow of capital, but also to the promotion of investment products as well. So what we are seeing today is reasonably new phenomena. When I was first on the market, in fact, we used to book overseas calls through an operator. There was no direct dialing. It only came in 1978. You couldn't just pick up a phone and phone as we do today, certainly not FaceTime. So we used to communicate with clients through telex or telegrams. And now, as I sit in front of my screen here, I can access information on thousands of businesses around the world. And then I can just buy and sell them literally at the press of the button. And these developments have changed Warren Buffett's world as well. Kids don't drink Coca-Cola. They don't chew Wrigley's gum or deliver newspapers anymore. Instead, they play Fortnite, they make TikTok videos, and they watch Kylie Jenner's makeup promos on their smartphones. So while Berkshire Hathaway has enormous value, it has a market cap today of $640 billion or 9 trillion rand, and it's underexposed to high-flying names like tech, it's trailing the S&P's performance. So because of its underperformance, underexposure to tech shares, it has trailed the S&P's performance. But still, even though Buffett's Berkshire Hathaway for the last few years has trailed the S&P and the major indices, it doesn't mean that the wisdom, the beliefs, the principles that he stood for and that his longtime business partner, Charlie Munger, stood for are any less relevant today than they were 20, 30, 40 odd years ago. And as I said, my views that I'm going to give you now, just to go through pretty fast, they've been formed by some copious notes that I made attending the Berkshire Hathaway's AGMs in Omaha. I attended 8 different meetings from 207 to 214. And from then on, from 2015 on, I've been streaming, much more comfortable sitting at home listening to it than having to schlep all the way to Omaha. There's an abundance of information that you can get on Buffett and Berkshire. But what I'm giving you now are my reflections on how these two great men have kind of influenced the way my approach to investment and life. And today is my 50th wedding anniversary. And having reached this milestone, I always think of Buffett's recipe for a successful marriage: have low expectations. Just to give you background, Warren Buffett, 90 years old. He'll be 91 on the 30th of August. Charlie is 97 years old. Buffett studied at Wharton University, University of Nebraska, Columbia Business School. He established his first partnership, I think, in 1956. And by 1962, he was a millionaire, dollar millionaire through many of these partnerships. What he says is that he began his interest in investment at the age of 11. And up until then, he was just wasting his time. He loves, even to this day, I just read a letter from him the other day, not to me, I mean, a letter to shareholders. He loves running Berkshire and always talks about tap dancing to work. And then he says that if enjoying life promotes longevity, Methuselah's record is in jeopardy. So he always jokes that the only thing he and Charlie want to know is where they're going to die, so that they'll never go there. And they're always quick to admit their personal weaknesses and, admit that they're sometimes slow to make changes. Even at their age, they still have a lot of ignorance. And they say that each mistake helps them remove some of it. Now, just Buffett was initially, his investment style was initially based on the teachings of Benjamin Graham. Graham was really the father of security analysis. And he was, for the reasons that I highlighted in the introduction, he was a big proponent of value investment. And he was adamant that stocks should provide a wide margin of safety between the price of the stock and its intrinsic value. In other words, you should always try to buy a stock below its intrinsic value. That gave you a margin of safety. What's intrinsic value? Well, you have to work that out yourself, but it's close to the net asset value. It's made up of a lot of things. Phil Fisher was also a big influence in Buffett's life and that. Fisher was a pioneer in growth investing and always said that the best time to sell a stock was never. Now, Buffett, I think what Fisher did was he taught, and this is important, he taught Buffett to talk to competitors, suppliers, and customers to find out more about a company, shaping the way that Buffett started to think about investment. But it was Charlie Munger and his association with Charlie Munger, which goes back 50 years, that he has now modified his approach and focusing, rather than trying to find those bargains or those value bargains, rather focus on high quality businesses with enduring competitive advantages, which Buffett called moats. And I'll talk about moats in a sec, rather than finding those quantitative bargains, which I think they used to say the last puff of a cigar. So it's important how even, how Buffett has changed his whole style. So they moved away from these deep value stocks in favor of well-run companies that build earning power. The first thing that one asks about Warren and Charlie is, how have they managed to rise above the waves of anti-business sentiment? You never hear a politician or the media attacking Berkshire in the same way as they would Bezos or Zuckerberg or Steve Jobs or any other moguls around there. Why is it that they have such a high regard? Why do shareholders trust them? And why has the money remained with them? Even in hard times, even in the 2008 or even in the last year, money doesn't leave them. It hasn't left them, even though they've missed out on the tech boom. And there are many reasons. The first is that he treats his shareholders, and that's big and small. It doesn't matter whether you have one share or 1,000, 2,000, whatever it is. He treats them as equal partners, and he always calls them partners. He's never exploited his position for personal gain. And he's always drawn a meager salary. I don't know what he draws today. The last I knew, and I still think it remains, is only $100,000 per annum. Well, he's not exactly a poor man. Also, he's very critical of tax laws and that favor the rich. In fact, in a letter dated 23rd of June, which he wrote around his disbursements, his charity things, he actually mentioned this again. He takes big stands against excessive remunerations of company directors or company packages, and also against companies who buy back their shares, these very expensive buyback programs. I'll talk about them a little later. He lives frugally. He still does. He lives in the same house that he bought 50 odd years more, I think 50, 60 years ago. I don't know what it cost, $38,000 then. He drives a very ordinary car. He eats hamburgers. He drinks cherry Coke, and he hates broccoli. And in 2006, he pledged to distribute his entire wealth to 5 foundations. And so far he's distributed, and you can work this out, get a pen out, he's distributed 236,000 of his 475,000 holding in Berkshire. And these are Berkshire A shares. So he's distributed 239,000 shares at $417,000 a share. That's what they trade at. So one Berkshire A today is at 470,000. And the balance, his entire wealth, the balance will be distributed upon his death. So he's given everything that he has away to charity. Just to go back to their annual general meeting, every year they would, Warren and Charlie would attract about 40,000 shareholders plus to Omaha. It used to be in the Quest Center. I think it's now called the CHI Health Center. It's an exhibition hall or convention hall. And as one regular attendee always explained, he says it's like going to church. Why do people keep going back? He says it's like going to church. You know what the message is going to be, but you still want to go. You still want to be there. You still want to be around those people. Once a gentleman who was sitting behind me at one of the meetings, he said, a lot of people call it the Woodstock for capitalists, but for him, for this particular gentleman, it was more like a Grateful Dead concert for the rich. I don't know if any of you remember who the Grateful Dead were, but anyway, he always opens his festivities with a very humorous video highlighting the companies in which Berkshire are invested, and he pays tribute to management teams. Then Warren and Charlie take questions from the floor. They've changed the format, and I'm sorry they changed the format, because they now have, when they get back to lockdown, if they ever do, please God they do, they now have 3 designated journalists, they have 3 selected analysts, and then they have the audience, and they alternate, and for 6 hours they take questions. It was much better when they just took from the audience, because I think the journalists, and also to an extent the analysts, become far more involved in the actual company and businesses that they bought. And it's become a lot more technical now than it used to. It just didn't used to have the same kind of fun flavor. They're serious. They're not frivolous. They're serious, but unpretentious. And they always laugh at themselves. Warren, I love this. He always says, I buy expensive suits. They just look cheap on me. And he always calls Charlie Old Testament, because of his conservative views. Anyway, it's a weekend of fun, and the convention center always highlights a lot of businesses in which they're involved, and there's a whole lot of events over the weekend if you want to stay. But I just want to move on to his approach to investment, and this is the essence of the way that he looks at businesses. His approach to selecting companies is always starts with an understanding of the business over time. So for him, before he buys a business, it's like through his reading, it's like building a relationship with a friend or a partner, a lover. You need to grasp what the company does, who runs a company, very important, its competitive edge, what the value is. And that's developed over time. That's why he would never go for an IPO. Simply doesn't know enough about it. And he always says, before you can look at the financials, before you start to look at the numbers, you've got to understand what the business does. And that enables you to look for answers in the numbers. Until you know what the company does, the numbers mean nothing. If you don't know the business, the financials are not going to help you at all. You can't review numbers in isolation. And a lot of us do that now. We go into spreadsheets and we fool around with numbers and then believe that these companies are good companies. You can't do that according to him. You have to know what the business does. Understanding the business is the essence. And he always says, if you need a computer or you need a calculator to decide whether to invest in a business, don't do it. Invest in something that shouts at you. If it's not obvious to you, if it's not obvious why you want to buy the business, walk away. He says you don't have to do calculations to the second decimal point. And he always mocks kind of analysts who tell you their earnings, to the second or third decimal point. And he's often quoted that if calculus or algebra were required to be a great investor, he said he would have to go back to delivering newspapers. So the source of his wisdom and understanding comes from reading. And he admits that he reads 5 to 6 hours a day. A lot of discussions in the meetings that I attended were about a successor. Members of the audience would always ask Buffett, why don't you appoint someone to shadow, why don't you appoint someone to shadow yourself so that they can learn from your experience and that. And he said, what's this person going to do? He said, he goes to the office, he sits at his desk, he takes out the Financial Times and he reads it. Then he takes out the Wall Street Journal, he reads it. Then he picks up the phone and he phones Charlie in California, has a conversation, puts it down. Then he picks up another journal and so on and so on. He says, what can you learn from that? He reads annual reports. He reads newspaper. He reads magazines. He reads trade journals. The one thing that he does not read are brokers' reports or bankers' reports. Both he and Charlie have a distinct dislike for brokers, bankers, business schools, and accountants. And every meeting you go to, they have a mighty attack on them. He's got a famous saying. He says, Wall Street is the only place that people ride to in a Rolls Royce and get advice from those who take the subway. And you can add quantitative analysts and derivative analysts to the mix. He always says of quantitative analysts and quants, he says they have very high IQs of say 150, and they feel that they have to use it. He says you don't need more than 120 to enable you to identify good investments. He says just sell the extra 30 points. Never mention EBITDA in their company, earnings before interest, tax, depreciation, and amortization. To them, depreciation is a very real cost of a business that can't be ignored. In fact, they warn that many businesses do not depreciate enough. Another thing you don't mention to them is the cost of capital. They don't understand the definition. The only measure they use is that whether a dollar that is retained in your company produces more than $1 worth of market capitalization. In other words, if you retain $1, can you make the market cap grow more than $1? That's the important measure that they use. So retained earnings need to add to the market cap or the value of the business. When it comes to business schools, Charlie loves to have a go. He says they reward difficult, complex behavior much more than simple behavior, but simple behavior is much more effective. And Charlie says some of the worst decisions I've ever seen are those made with future projections and then discounted back. In other words, he says, where you go and project forward what the company is going to earn and then you bring it back to a value discounted cash flow. He says they teach that at business schools because they've got nothing else to do. They've got to do something. And accountants, Charlie says they have many ways of cheating in accounting. There are many ways. But both of them suggest and both of them say that, you have to learn accounting because it is the language of business. Just back to reading. He always counsels young people, to read Benjamin Graham, read Phil Fisher, read annual reports, but do not do equations with Greek letters in them, meaning derivatives. So they always go at derivative people. They say that they caution that ignorance combined with leverage, in other words, that's what they believe derivative traders do, he says, can have explosive consequences. So learn as much as you can from reading is the fundamental message. And the more you learn about things around you, the more you're going to want to learn. Another area which is fascinating, they focus on fundamentals. They don't pay any attention to macro forecasts. They never talk about macro situation. Macro situation meaning the economic situation. You know, those elements that make up the economy that we talk about all the time: inflation, interest rates, the Fed, and so on. They never talk about that. And whenever questions were put to them about macro issue, Buffett would respond by saying, we put those in the too hard file, meaning the too hard file is something they can't really ask. And they say, why spend time talking about something you know rather than, why spend time talking about something you know nothing about? Got that wrong, sorry. In other words, why do you ignore what you know about companies for forecasts or predictions about things you don't know? You know, that's just silly. In other words, focus on companies, forget about trying to predict where the economy is going, where the Fed's going. In fact, they say monitoring the Fed is like watching a good movie where you don't know the end. You don't know how it's going to play out. So really, they say if you're confused about Fed Reserve policies, don't worry, you're not alone. They do have an inflation. This is the only thing I ever heard Warren Buffett talk about on inflation. He said the only prediction against inflation is to prove your own earning power. In other words, invest in yourself. You know, he said, become a brain surgeon. You'll earn a lot of money in that way. And says also invest in good companies that do not require heavy capital investments. In other words, he avoids companies with high capital expenditure or those that need high capital expenditure, but invest in a good company. You know, he always says that once you buy something, everybody's going to offer you opinions about what you've bought. And he says, you know, you have to develop inner peace and emotional stability to survive. And he says, if you've made the right decision, just hold on as long as possible. The one thing that I religiously practiced that Buffett advocated was not spreading investments too wide. In other words, keeping a small universe of investments, but know those investments well. I think he once said, you know, keep all your eggs in one basket, but watch them very carefully. And also on the subject, he said, and this is a well-known quote that he's made, he says, I can't be involved in 50 or 75 things. That's the Noah's Ark way of investment. You end up with a zoo. He says, I put meaningful amounts of money into a few things. And he's also said on occasion that on the same subject of spreading your investments too wide, he says, you know, if you have a harem of 40 women, you never get to know any of them very well. So they always stress that they look for businesses in which they think they can predict what they're going to look like in 10 to 15 years' time. And that's the right thing if you're going to go for long-term exposure. What will the business look like? I think maybe 10 to 15 is a bit long, but what will the business look like 5 to 10 years' time? But, you know, things change in hindsight, and some of the examples that they have made have backfired on them. You know, Buffett would often, when he was discussing tech, because he always said, I know nothing about tech, I'm not going to get involved in it as well. This is before he even went into IBM. And he'd say, take Wrigley's chewing gum. I don't think the internet is going to change how people chew gum. Well, it has, you know, and it's also changed the way that people drink sodas or sugar, you know, things like that. So things have changed. And I think the spread and popularity of the internet has challenged many of the moats that, you know, made up his iconic companies, the companies in which he invested. So things have changed, and I think one's got to change with it. Just on a moat, and I think this is important in the discussion because we often talk about it and one's got to know how to apply it. You know, a moat simply is often associated with Buffett, but it's a structural competitive advantage that helps insulate a company from competition. Simply, moats give business an advantage over others. So, for example, I'll give you what are moats. Like MasterCard, Visa, Facebook, Google, the sheer size, their scale, their popularity are very difficult to emulate or change. You know, you can't you want to start a credit card, who's going to accept it? Whereas Anywhere in the world, you've got MasterCard, Visa, so it's very hard to replace them. Even Facebook, with a huge population of people that use it, Google, the same kind of thing. Also, where you've got economies of scale, he would use like FedEx or UPS, because if you want to send a package, you know that FedEx have got offices around the world. You've got strong brands, intangible assets, patents, licenses. Those all give you a moat. For example, a casino. A country or a suburb or a town will only issue one casino license. That gives you a moat. A financial exchange, a license is issued, gives you a moat. Ferrari, Coca-Cola. I don't know Coca-Cola anymore. I think the moat is shrinking, but that's a moat. Also things like a lift. If you've got a lift in a building, if you put an Otis lift, you can't go and change it. You've got to stick with the Otis lift. So they've got a moat. They've got you under their control. Jet engine, you can't mid-flight change a jet engine. Bank, IT services, all of those are kind of moats. Even things like a speed track or an airport in a city. They've got. I know Sydney Airport is up for grabs at the moment. That's got a moat. That's why, because you can't have you can't have a competitive one as well. So it's a very key attribute to investing. And, just like we're now assessing how much an industry is going to affect society and how important it is, how is it going to grow? You also have to keep looking at a company's competitive advantage. Look, these moats can shrink, they can reduce. We've seen it with brands like Coca-Cola, Heinz, with a move towards healthier living. For beards, Gillette, all of a sudden the popularity of beards and the event of lockdown have challenged the Gillette's blades. Suddenly, they're not as popular as they were. The internet, this is also another important point. The internet and e-commerce have allowed producers of goods to reach much wider audiences. And that's threatened the control of the big, powerful brands that used to dominate the media, the TV channels, the airwaves, cinemas, etc. All of a sudden, those big brands that had huge dominance are suddenly challenged by, by overnight company, by craft beer, by makeup companies, all of that, because it's so much easier today on social media to advertise. And also consumers are not interested in what you say or what the public relations people say. They're more interested in what other people say about the brand. That's why you get the thumbs up or thumbs down. So new moats are being formed all the time. Today, new moats are around Netflix, Tesla, Zoom. All of these are companies now that are forming moats, which may or may not shrink. So just one thing on the power of brands and how brands can influence people. Shortly after the 2007-2008 financial crisis, in one of the sessions, Buffett was questioned on why he had lent money to motorcycle manufacturer Harley Davidson, which was facing quite a few problems in that. And he replied, he said, listen, any company that can get its customers to tattoo its logo on their chest can't be that bad. Just doing deals. I'm running out of time soon, and I want to get through this pretty quickly. One is when they do deals, they're very choosy about who they do business with, no matter how profitable the company. They always quote that you can't make a good deal with a bad person. And they would always buy businesses with sound business models, very good management, where they have existing proof of management capability through performance as well. Very seldom do they do due diligence. They can make up their minds, and they've said this, they can make up their minds in 5 minutes whether they want to do the deal. And they know very early in a conversation with anybody if there's a chance of a deal or if there's no chance. And if there is no chance, they don't waste time. They just cut the conversation there as well. But if they get through the filter, then there's a very good chance that they will act. I know it's more important, more difficult now because they have a massive amount of money. They've got something like, I don't know, $150 billion on their balance sheet at the moment, which is very difficult to spend. So, for them to kind of do these deals now of that size is not as easy as it once was. But if they do commit to a deal, they do not attach conditions. and they do not break their promise because of events. So if they do a deal and the market collapses, they never go back. And that's happened many times in the history where events have happened where they could have pulled out or they could have reneged, and that never. And what they do say is where deals have gone wrong, they reckon they would have gone bad even if they would have conducted a due diligence. So they never sign management contracts. In other words, if management wants to go, they're free to go. So it's their job, they say, to ensure that management stays on. And it's their job to ensure that management remains enthusiastic and feel wanted. They feel wanted after being sold, after selling out to Buffett. In many cases, Buffett doesn't take out, he always maintains leadership. He always maintains them. It's more often that a family member wants to sell out. That's how they come in, or alternatively, they feel that it's time to get some cash or something like that. But he always leaves it up to management to run a company. And he says on average, they hardly talk. Sometimes it's once a year, sometimes it's mainly twice a year. What they do try to do when they buy a company is preserve the culture, brains, energy, and passion, of that business. They never discuss money because they reckon that the people who come to them still want to continue working and have got enough money. And he says, if money comes into the discussion, they will pull out simply because they'll never be able to satisfy the person. Once you're after money, he says, it's a never-ending issue and they'll never be able to satisfy you. I wish I could tell you the story of Rose Blumkin. We're not going to have enough time, but age is never an issue with him. He never doesn't do a deal because age of a problem. And any of those who know the story of Rose Blumkin, it's well worth reading. But she was the founder of Nebraska Furniture Mart, and she worked until she was 103, and she died the next year. And Buffett always uses that as a threat to other managers who want to consider retiring. Look what happened to Rose when she retired. He's got a lot to say about other businesses, and this is a very important point as well. He objects to companies publishing directors' remuneration. I know it's a standard today. He says, but what it does is it creates envy and it generally pushes up the levels of compensation. You see what someone else is earning, you want the same, and so on. And when it comes to directors' remuneration, he's a massive critic. I could put a lot more information around it, but time prevents me doing it. But, he always says that CEOs put Cocker Spaniels on the remuneration committee, not Dobermans. He says, compensation committee should be decided, or compensation should be decided by genuinely independent directors, not by friends of the CEO as well. So highly critical of directors' remuneration. And, he always says that if you look at the bonus scheme, and if it takes 100 pages to explain the bonus scheme, he says, then, something's wrong. He has similar views on share buybacks as well. He's very critical of directors who buy back shares, even though Berkshire has done it themselves, and they've done it for a reason, because they felt that it was value. They would rather put their money in their own business than put it elsewhere, because according to them, Berkshire was trading below the intrinsic value, which made sense. But he says that generally directors issue share options low and buy back shares high. Just on difficulties in a business, he warns you. When you see difficulties in a business, he always says, and it's another well-known quotation. He says, no sooner is this one problem solved than another one surfaces. So when you see problems in a company, believe me, others are going to surface. And he always says, if you see a cockroach in the kitchen, sooner or later, you're going to meet the family. And he's also very critical of companies that just want to do deals for the sake of deals. And he says, when a chief executive officer is encouraged by his advisors to make deals, he responds much as would a teenage boy encouraged by his father to have a normal sex life. He says, it's not a push he needs. In other words, don't push the executives to do deals. They'll do them. I'm nearly finished. This is the last. I want to go through this because I find it very interesting. It's the last issue that I want to take, and that's his advice to young people. And it's something that I've always wanted to develop and expand on a lot. Buffett, does not believe in plutocracy. In other words, he doesn't believe that a person or a family should derive power because of their wealth. Children must make their own way in life. And he would always tell his audiences, he says, I want to give my kids enough so that they could feel they could do anything, but not so much that they could do nothing. And he's actually followed that. He's given his kids a lot of money, but certainly not the billions that he's made. They're all wealthy and they're all very good people and very magnanimous. And he always tells kids, you must do something you love. Don't live your parents' biography. Develop a passion where you have the aptitude. When you love what you do, he says, there's no heavy lifting. And, don't follow what you think your parents want you to do. And your best investment is in yourself. Take control of your own education. He's very big on communication skills. He did the Dale Carnegie course when he was young. And he says, to be successful, you need to develop your communication skills. Communicating orally and through the written world is undertaught at colleges. In other words, they focus on the wrong thing. They don't teach enough of this. Again, very much on the reading theme. Learn as much as you can of what's happening around you. Read newspapers, read journals, and so on. And he says, go to bed at night with a little more knowledge than when you woke up. I love this one as well. He says to young people, imagine you have the choice of a free motor car that must last you your whole life. In other words, he says, you can choose any motor vehicle that you want. It's got to last you a lifetime, though. He says, what would you choose and how would you treat it? Obviously, he says, if you know it's going to last you, then you must read the manual carefully and you must treat it caringly. And he says that's how you should treat your body and mind, with respect, because this is the only body and mind you will ever have. And of course, when it comes to life, he says, find the right partner. He says you behave much better when you're happy. I've got just to end, I want to read something that he said in his June letter of 23rd of June. This is when he just on the whole donations story and that. And I'm just reading the conclusion as well. He said, I'm optimistic. He says, though naysayers abound, as they have throughout my life, America's best days most certainly lie ahead. What's happened here since 1776 has not been a historical fluke. Philanthropy will continue to pair human talent with financial resources. So too will business and government. Each force has its particular strengths and weaknesses. Combined, they will make the world a better place, a much better place for future generations. Thank you. I hope that was interesting. I tried to get through it fast. I spoke a lot, but are there any questions of Buffett or anything? I'm very happy to take.
Yeah, thanks, David. One of the comments was, please don't stop enjoying everything.
But I can give you his views on gold. I can give you, if you want to know his views on all other things, gold, commodities, airline industry, cigarette business, all other things like that. I will say one thing. Okay, I got to give two last quotes. In every Buffett presentation, I've done these, and I've always loved this. On life, he'd always say, he said he had a friend who spent 20 years looking for the perfect woman. Unfortunately, when he found her, he discovered she was still looking for the perfect man. And the other one is, no matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. So I'll leave on that.
There are a few questions, actually. I think a lot of people would love for you to talk for another hour, but maybe we can just look at some of them. One of the questions was, Buffett seems to dislike technology stocks and is this not a long-term problem? Gates and Buffett know each other well. Perhaps this could be an ethical issue as to why he doesn't like these stocks.
I think that's what I try to identify. What's happened is that I think tech stocks are outside his level of comfort. It takes a completely different understanding to work out where we are. It's only in the last few years. Listen, hold on a sec. He bought a big chunk of Apple, and I think he's got $120 billion of it. So he's not exactly short on Apple. You know, he's got a massive exposure. So I don't, you know, it's a big and he sold it prematurely and he admits it. And not this year, but last year, he did admit to you know, to having missed Amazon. But I think just his whole process is you know, has been very slow. Look, he's also handed over to Todd and Ted, you know, to two portfolio managers. He's given them a few billion each. But I don't think they've got enough to have changed it. And they're also applying very old measures. So, you know, I think that was the whole point today. I still think that if he would have applied the same kind of rules to what's happening now, I think he would have been able to pick up you know, more exposure to technology. It's one of the reasons that we still have some Berkshire in our portfolios, but we're not adding in new portfolios. So where we've had it for a number of years, we might have it or we might have got out simply because so many of the businesses that he has are not those high growth stocks that I think are going to feature in the next 5-10 years. I think we're going to an enormously exciting period of technological advancement. You know, we don't even know it. And unfortunately, I don't think you're going to, I think, you know, by the kind of exposure in some of these old stocks, I don't think are going to match the kind of growth that we're seeing in the energy transformation, in the medical transformation, you know, in this what they call digitization, the cloud, 5G, even the renaissance that we're seeing in the automotive industry, this move to electric cars. So I think you've got to, you know, you've got to keep up with what's happening. And again, the only way to do it is you don't have to go into the technology. Just read about these businesses, read about these, you know, just read about these industries.
Thanks. This obviously ESG is a big part of our chats of late, and you know, it comes up in most conversations with regards to investing. What's your view? It's been asked a couple of times on ESG funds and the companies.
It's interesting. I don't believe. Okay, I'm a big believer in ESG. Okay, you know, I certainly, if it didn't come through. It was the whole purpose of the way that he looks at businesses. You know, Buffett used to say something very interesting, you know, and he would say this about business leaders. You know, he'd always say, I don't mind if you lose money, but don't lose your reputation. And then he also made another comment, which is so, you know, not interesting, but important. He said, it's not whether you're found guilty or not guilty on a charge. You know, it's why you were there in the first place. In other words, why did people suspect you in the first place of having cooked the books or having done something like that? You shouldn't have been there in the first place. You know, your name shouldn't have been in the headlines, even if you were found not guilty. And I think that's always been his approach. He's been, you know, it comes through in the way he does deals. Everything's on one piece of paper. If you read the Rose Blumkin story, it's such a magnificent story. And that whole deal was done on one page, which cost $1,400, I think, to notarize or something, $1,400 in that. And that's been his approach. So he's always been ESG, you know, his whole attitude towards other people. You know, he said he was privileged. He had a very privileged upbringing in the sense that he was from a middle-class family and could afford to do what he did. But he believes that everybody should have the same opportunity that he had, you know, no matter what your background. So from a societal point of view, he's very important. The fact that he's giving all his wealth to the Bill and Melinda Gates foundations, you know, he resigned, but that's because he's resigning from a lot of boards. I think it's more his age. It's got nothing to do with their, you know, with their divorce. In fact, his whole lifestyle itself was rather interesting because his wife left him many years. She didn't leave him. She went to pursue a singing career in Los Angeles, but her best friend, old Astrid Mix, she moved in, and when Susie Buffett eventually died, he married her, but the best friend came to look after him. So I don't think he can really criticize kind of some of the relationships, but I won't go into that in too much detail. But it wasn't as a result of that he resigned. But I think that he's always given back to society. The mining side, I don't know, this that kind of side, but he's never bought miners. He's never believed in companies that spend a lot on capital goods as well. Charlie's different, hey? Charlie, when it comes to talking about climate change and when it comes to those, he's on a different plane. I think they disagree. They're on different views as far as that's concerned. So Charlie is, he's a bit of a cynic when it comes to one or two of those other things. But I think they do believe they're moving around or coming to the belief of clean air and having to do the right thing. But
so
do you buy a fund? Do you buy a fund? I don't. Just make sure you buy the right kind of companies. I think you should, when you look at a company, you should look at it through those eyes and understand management. Are management there to make money from you, or they're going to make money for you? You can always see from their actions. Are they issuing themselves big share options? Are they just pursuing deals for the sake of doing deals? Those are the questions you must ask about management. And I think that will determine, because sometimes ESG funds, I don't know if they ask all the right kind of questions.
So one of the questions also came up, that you talked about values, and that now Buffett's values are deemed old-fashioned, which is a bit of a shame, I guess, which leads to the question, is it maintainable in this day and age, considering speed and greed in today's business, to have those types of values?
From my point of view, no. I'm not a value investor. I'm not, I'm a growth investor, in the sense that I like to, where I've adapted Buffett, is understand where the business is going to be 5-10 years time. Try and project forward. Also, make sure you know the business. And that's why I'm very nervous, because, when you go into that area, Flynn, you've got a lot of youngsters around you, and they know every new tech company that's coming. They start to mention names, but they haven't given those tech companies a chance to grow, to understand. You haven't had a chance to understand them. And I feel you've got to do that. Don't be too quick to rush into the IPOs and those businesses. Just get a grip about the business before you go into it, even if it is a high-tech company, So be very careful around those things. We all want, and that's why, I don't know if anybody picked it up, the get rich slowly area. Get rich slowly. You don't have to get rich fast. You don't have to buy everything that's the latest thing now to try and get rich. Yes, you might hit it once, twice, 3 times. The 4th time it takes you out. So just be careful. So get there slowly.
So it wouldn't be a Q&A if there wasn't cryptocurrency brought up.
Yep.
So the question has been, what's yours and possibly Warren Buffett's view on cryptocurrencies?
Well, I know Buffett's view. They don't answer the question. He didn't answer the question. He just refuses to, but Charlie just reckons, he's adamantly against it, simply because of, I think, some of the risks. And what they said about commodities, it's the same kind of thing. They don't go into commodities, because what happens is you buy commodities and you hope that somebody else buys it from you at a higher price. That's not their style. So I'll answer it in the best way that I can. It's a store of value. But when you buy it, you're hoping that someone else comes and buys it at a higher price from you. It doesn't create anything. And even gold, they will not touch gold. They've been adamantly against gold. There are a lot of quotes about, gold. If you put a piece of gold in a safe and you come back 20 years later, and you come back, it's still a piece of gold. And also Buffett would say that you dig a big hole somewhere in Africa or wherever it is, you go and you mine some gold, and then you put it into a bar, and then you go dig another hole and you get somebody to watch over it. So he's always, I don't know the exact quote. He says it much more articulately than I have. And that, but on the same basis is it doesn't produce anything. Gold mining produces it produces jobs, but the piece of gold itself doesn't. And I think that they say, look, rather buy a farm, rather buy land, grow crops. You're doing something, you're producing something. So their whole approach has been around productivity. Buy something that produces something else. And I think on that basis, they would never buy something like a cryptocurrency or gold or a commodity and that, where you're simply hoping that somebody else comes in and buys it from you at a higher price.
Another question that's come up a bit is asked if you've actually met Warren personally.
Well,
and
we
what
used
was
to.
his demeanor like? And then to finish it off, do you think there'll ever be another Warren?
No, not the same personality. I think they stand out, and that's a sadness. And I was really blessed, and I mean it. It was always a wonderful experience to go and sit there and listen to them, because they're so humble, they're so real, and they never take themselves seriously. And I think that's what's just distinguished them from everybody else. And their wisdom is unique. So it's going to be very difficult to find people with that kind of personality. You've got the Howard Marxes today. You've got a lot of other people that are very bright and smart and try to copy them. But I don't think you're ever going to have a person that can attract 40,000 people to come to their general meeting, year after year after year. I don't think they're going to build, anyone else will build up that kind of, that kind of force anymore. It's going to be very difficult. What was the other question? I think
no, it was just around his demeanor. So
yeah, I think it's
that
going to be very difficult for someone to emulate that. It's not going to be easy, and I think we'll miss them. Look, they're already 90. Charlie's 97. It's very hard for them to give the same kind of wisdom, and especially in these kind of markets now. And I think even lately, the AGMs have become pretty boring because they've been in lockdown. And what happens is that they, because they're in lockdown, the questions coming through are very technical, and focused. The question was, have you met him? In the early days, in 07, 08, around there, foreigners could queue up and we'd shake his hand, So he was very sweet and magnanimous, and he'd look at you, and there were about 300 or 400 foreigners, and they were all just kind of filed past him and that. So, from that point of view, yeah, I have met him, but I haven't met him. Howard, we met. Howard, his son, sat at our table at Gorat's one evening, and we had dinner with him. And Howard was very involved in South Africa on conservation. He's a conservationist as well. So he's got quite good links to South Africa. And Howard would take over chairman when Warren steps down or, God forbid, dies. So, yeah, that's it.
We've got 2 more minutes. So last question, taking Warren's investment insights and all you've spoken about today, are there any companies that stand out for you in South Africa that would be a raging buy on those principles?
That's hard. When Warren Buffett, and this answers it, was asked, why don't you invest in emerging markets? And to an extent, the same thing happened in Europe. And he would say, there's nothing in America that I can find that I can't, there's nothing in the rest of the world that I can find that I can't find in America. That was his question. It doesn't really answer the question, but I mean, that's what he says, we can find. At the moment, I don't know. I'm battling with a lot of, with a lot of issues here. I don't think I think I'm still trying to work my way around the mining story at the moment. I can't get an answer whether there is a commodity cycle or there isn't. Buffett would never go for that. He would never go for a company with big depreciation, simply because most of the money you make goes back into developing the mine. So do we have any Seas Candies here? Any of those companies? Not really.
Thanks, David. Once again, awesome presentation. And thank you to everyone that joined us. We had 400 people today, so that was very cool. Everyone out there, stay safe. Please be careful. It's testing times, as you know. And yeah, we look forward to possibly more on this topic in the next webinar, or something even more insightful as well. Thank you, David. Appreciate
Pleasure.
that today.